Business finances can seem complicated because it feels like you're learning a new language and there's a lot of moving parts. One of the reasons why the financial side of the company is so difficult to learn is because you're relying on the profit and loss statement to make decisions. There are actually countless ways to view financial information, and here are the 7 that I recommend you understand to better lead your company. When you think about the 7 financial viewpoints, consider the first 3 as foundational pieces of your business. The financial strategy determines your prices, and your prices drive cash flow. The remaining 4 financial viewpoints are simply reporting formats of how cash flow through the business. So the cash that qualify as an expense show up on your profit and loss statement to calculate net income, and the costs that qualify as a tax deduction show up on your tax return to calculate taxable income. The costs that are considered assets show up on your balance sheet to calculate the net worth of your company, and the costs that are considered a return on the owner's investment are used to calculate the return on investment for the risk that the owners took when they started the business. One of the quickest and easiest ways to understand business finances is to start with following the money and understanding how money interacts with your business. So there's 3 main ways that money interacts with your business. First, your business generates money. It also spends money, and it also needs to keep money. And so this creates a very simple money formula. There's money that comes in minus money out, and that equals the money that remains in the business for you to use in the future. Let's start with the 3 ways that your business generates money. So the first one is investments from the owners, and loans from the bank, and sales from customers based on the price that you charge. The first 2 are not sustainable long term because eventually you'll lose the ability to borrow money, and the owners will eventually either run out of personal savings or they'll stop believing in the idea. Also, the first 2 need to be paid back. The company needs to generate enough cash flow to operate plus pay back the loans with interest, and the owners also expect a return on their investment. The first 2 also come with strings attached. Business partners and banks have opinions and expectations for how you'll run the company because they want to ensure that they will receive their money back. The third way, sales from customers, that it doesn't need to be paid back as long as you deliver what you promised. Sales from customers is the only sustainable, renewable way to grow your business. There are 3 primary big ways that your business spends money. The first one is a return on investment. This is equity payments, either distributions or dividends, and the payment purely represents a return on the investment for the risk the owner took. This is not owner's pay. That comes a little bit later. The second one is loan payments. This would be the principal and interest, and then also maybe even loan fees. And then the third category of the way your business spends money is operations. So this is broken down into 7 main types. You've got materials and equipment, marketing, employees, and the employee category would include salaries, wages, benefits, payroll taxes, training, everything to do with employees, including you, your owner's salary if you work in the business. Also, another category is the vehicles, fuel, repairs and maintenance, and auto insurance. Your building, maybe rent, utilities, insurance, cleaning supplies. And then also charity. You may want to give back to your community. And then also the last but not least is the business expenses. And this would be at the business level, your general liability insurance, legal and accounting fees, and then also the income taxes. So with all 3 ways to spend money, the money is gone and it has very limited, if any, value to the business in the future once the money is gone. When money stays in the business, the money has an opportunity to impact the future. Money gives you options. And so there are 3 main reasons to keep money in the business. The first one is so that you can stay in business thanks to some working capital. The business keeps going even when the unexpected happens. It gives you the ability to replenish inventory while you wait for customers to pay you, and it also gives you the ability to pay bills and employees on time if a few customers pay you late. It also gives you the ability to survive a surprise, and in your personal finances, this is referred to as an emergency fund. Well, your business needs this as well. It needs a little bit of a cushion because you're not sure what or when something's going to happen, but you're most likely going to have something unexpected coming your way. And so when you provide working capital for your business, it helps you stabilize cash flow to reduce financial surprises, so that way you can stay in business even when a surprise happens. The second reason to keep money in the business is so that way you can maintain your business with capital reserve. The goal of this fund is to help your company maintain the current level of operations, so when it's time to replace trucks or tools, cell phones, or computers, the company is not strained financially by the purchase. This allows you to maintain your current level of operations without putting a financial strain on the business. The third reason to keep money in the business is so that way you can fund your growth plans. It will give you an opportunity to hire more people, buy assets for those new people, add a new revenue stream, buy a building, buy a competitor. All of these, when you have that type of money saved, it gives you a lot of options. And so you might still borrow a little bit of money, but what would it look like if you were able to fund that growth plan with 50% cash and then 50% loans? It gives you a lot of options. So when we go back to the very simple cash flow formula, we want to really just focus in on the money coming into the business. It's coming from our customers based on the price we charge. And then money out, that's to cover everything. Our employees, vendors, tax authorities, banks, owners, everyone. And that leaves the money in the business to help us not only maintain the business when surprises happen, but also funds our growth plans. And that's why the price you charge is so important. The prices fuel your business and is the only sustainable source of money. Your prices must cover all of the cost of doing business, or you'll end up relying on either money from owners or loans from banks to help you keep your business going. Have you ever planned for money to stay in the business? So did you know that our brains are programmed based on the psychology of money? Some of us are programmed to make money, generate sales, really earn the money. And then some of us are actually a little bit more on looking for ways to preserve money and keep the money in either our personal bank account or in our business. And so if you fall on the left side with generating money, you're more likely to take risk, put yourself out there, you're very optimistic, and you'll do anything to say yes because you've got a very abundant mindset. But over on the right with the cash reserves, when you want to keep money, you're a little bit more cautious. You definitely plan for the unknown. You're naturally skeptic. You may even say no before you've even heard the idea. And then also you've got a very conservative mindset. And the goal for being an entrepreneur is to have a healthy blend between both. And so identify whether you're leaning a little bit more on the sales, earning the money side, or saving the money, and build up your team with people that are not like-minded so that way you can balance each other out. And if you're not ready to hire someone, you can look for a business coach that will help you kind of balance it out. Here's an example. Imagine filling up a water can with the money from your customers. $100,000 comes into the business, and water needs to cover all three: the return on investments through distributions, loan payments, and then also operations. So the total water that we need to pay all of our financial obligations is $92,000. When there's money left over, you have a choice of how to use that money in the future to help your business grow. Does your company run out of water before all of the bills are paid? If you find your business in the red, here are some ways to help you stop losing money. The first one is to review your prices to confirm they cover all three costs of doing business plus money for the future. Confirm your prices are generating the profit that you planned. It's very tempting to set the price and then move on to the next thing on your to-do list. But think about your prices as the plan. It sets the stage for what you expect to happen. It's important to circle back, take the time to compare the plan, the price that you charged, to what actually happened to confirm that the prices actually generated the profit that you planned. And last but not least, confirm your customers are paying on time. It's really easy for you and your team to get caught up in the day-to-day and skip a few steps in the collection process. It's important to have a very consistent collection process regardless of whether you need the money today or not. The bottom line, yes, business finances can seem complicated, but when you focus on how money flows through the business, you'll simplify the financial side of your business. So instead of drowning in the details, take a step back and look at the big picture. Money in from customers, money out for everything equals money remaining for the future. Cash flow can be simple when you let it. Thank you so much for watching. As always, if you've got a business finance question, please reach out. I'm more than happy to point you in the right direction.